101, week 10. We brought back our friend, Aaron Chapman. Aaron, thank you so much for coming on. This week, we're discussing timing the market. And what better way to discuss this than live at the F1 downtown Phoenix?
Well, one, I'm not going to miss an invite to come with Jessica downtown, the rooftop bar, and the F1 ripping by. And the timing, as she's referencing, is every now and again, you got the cars coming right by and you can't hear nothing.
No, but it's great because we're right in the middle of the action and we're discussing a very important topic on timing, right? Timing the market.
Timing the market.
So tell us a little bit more about timing in the market, because there's a few phases in the market that real estate investors or anybody who's purchasing real estate should really be watching, right?
So in my opinion, okay, this is going to be all Aaron Chapman opinion. And Aaron Chapman opinion is built off of being involved in this since 1997, right?
Okay.
I've been financing investment real estate since 2003. I've been a real estate investor since 2001. So timing, everybody thinks you have to be watching it perfectly to get in on that. My belief is timing the market is being in the market all the time. So it's your time in the market, and you eventually have an opportunity where you get to time the market. So let's think about this as you're a star football player, right? Uh-huh. You're sitting on the sidelines, on the bench, preserving your strength and your energy to jump in on that play when it's going to hit the highlight reel. But what you find out later is everybody who hit that highlight reel had their ass on the field already. So unless you're on the field, you're never going to hit the highlight reel. So when it comes to timing the market, there's no real way to time it because nobody knows until the market has passed that timing. So what you need to do is set your baselines, understand the fundamentals, and understand the actual basics. And because when it comes to tactics and strategies, they'll change with the market, right, but it's the principles that stay the same. So what are the principles of investing in real estate? What are the principles of success? Set those, get it built correctly, and then be in the market and watching, and only take the deals that fit. And eventually you grab something, 2, 3, 4, 5 deals that absolutely just dominate your portfolio. But the others are good, solid bunts that get you on base, and then you'll hit a bunch of home runs. But those home runs come intermittently because you're on the field playing ball.
So I have a question. Okay, so you're timing the market because you're time in the market. So would it be more intuitive when you're in the market so actively that you kind of see when the curve is coming?
Yeah, you'll see the curve coming, and you'll see it in different markets. Sometimes the curve is in one market, but not in the market you're in. So there was a time in the state of Arizona, 2010, 2011, 2012, you just killed it. You couldn't not win at that time, right? Because everything was cash flowing, everything was cheap. Yeah. And then you move on to other markets. My clients went on from the Indiana, then Texas, then Tennessee, then Missouri. And some of those markets still perform. The thing is, you got to understand what is a performing asset, what is not a performing asset. And you can make assets perform with leverage that are not going to be, home runs. They're not going to be something you're going to be screaming about, but they will definitely make you wealthy. But you have to be willing to stay in it and stay in it long term. Timing the market, in my opinion, is about being able to get home runs instantaneously versus those bunts that get you on base and getting you around the base and get you to the final, get you to home plate. But they take time and they take patience. You got to watch the plays. But if you understand what those plays are, you understand exactly how to do that, you will be able to make it to home plate. I wouldn't say every time, but the majority of the times.
Okay, so let's break it down a little bit in regards to a better time than not such a good time to come into the market, right? Because there's always a great time. We're always going to find some sort of opportunity out there regardless of where we are in the market. And a savvy investor would know that, right? But in regards to, kind of watching the curve and trying to stay maybe a little ahead of the curve, what would your suggestion be to just get into the market or in the timing of the market for those who are on the fence of jumping in?
Well, if you're on the fence of jumping in, you have to make the decision whether or not it's worth getting into real estate or not. If it's worth getting into it, then it's okay. I got to set up my team. Often people believe, I got to buy the property first. I got to buy the real estate first. I think that's wrong because a lot of folks will buy it and they're like, oh, wait a minute, how do I have to have that vested? How do I hold that? What kind of leverage do I need to do? And they just jump into it first. No, find your lending partner first. Find your leverage partner first. Figure out what it takes to be bankable. Then once you're bankable, then take those assets and how do you structure those assets that you have to invest in real estate? Is it to pay cash for a property? Is it leverage the property? Well, how do I go about that? Am I going to hold it in a personal account and then close with 20% down, 30% down? Decide that. Then it's, where do I put that capital first? I'm a big fan of doing the infinite banking strategy. Take your money, put it into a life insurance policy first, take the money out of the life insurance policy, buy the property. But if you're going to buy the property, you're going to put it in your personal name, or you're going to put it into an entity.
Right.
Set up the entities first. I'm big into set up a family trust, living revocable trust, because that's bankable. Then your Wyoming holding company. Then your Wyoming holding company sets up the entity in the area where you're planning to buy. If it's Arizona, it's an Arizona LLC, that the sole member of that LLC is your Wyoming holding company. Then from there, thank you. And then the Wyoming holding company is owned by your trust, which is directed by you, the trustee. So if you have that proper setup, then you're going to go out there and then you start finding the properties that fit what you're looking to do. Now, what is a good property? What's the perfect time in the market for the property itself? Finding anything you keep reasonably rented the entire time you own it. Can you raise rents on it, and will they pay off the loan? Because if it stays reasonably rented, you can pay off the leverage.
Right.
By paying off the leverage, so less you invest in the home, which would be anywhere 15 to 20% down, the more the leverage payoff as far as the amortization of the loan returns to you. The more you put down, the less the amortization returns to you. I'm not going to get into specifics on that. We'll have to talk about it. How do you do the math, right? When it comes to appreciation on the property, however much the property appreciates, it's based upon the total value. But that appreciation can be divided into what you invested. The less you invest, the more you gain. So again, leverage is an absolute necessity. Then it has to pay for itself. If you're not going to cash flow, even if it's $1 cash flow, at least it's cash flowing. If you got to go to your pocket, you have to question whether or not the asset's worthwhile. That's where amortization, appreciation, and tax benefits kick in. And you have to weigh that out. So there's a ton of strategies, but principles will always be the same, and that's we got to really dig deep on. What are the principles? What are you looking for? What is your structure? Then move forward in any market.
Yeah. And I think this is really important to really understand as real estate investors, is that, yeah, the market is cyclical. It's always going to have the peaks, the expansions, the contractions, but it's really, really important to have that team, right?
Yes.
The team is the one who's going to be able to help you find the property, underwrite the property. There's a lot of creativity in the market. So people think, oh my gosh, the market is this, the market is that. Really, it's just about finding the deal.
There's
right?
deals in every market.
Yeah.
It doesn't matter what the market's doing, but there's deals in the market.
Right.
But if you don't know how to define a deal, then the whole market looks bad.
Right. And that's why it's so important to build a team, right? To call your Aaron Chapmans, your Jessica Bohorkises, your Patricia Josens.
If you call anybody else, I'm going to question your judgment.
That's right. So, Aaron, I absolutely love this conversation because it really gives us a little more insight that, you know, obviously people wait. They want to wait for the buyer's market. They want to wait for, you know, if they're selling, they want to wait for the seller's market. But realistically, especially when we are expanding our acquisitions, right? There's always something in there. We just got to know where to look for it and who to have in our corner.
And a lot of times people will sit in the background and say, I missed it. Damn it, I missed the market. No, you didn't. You can literally make another highlight reel play in the game. Just stay in the damn game. You might think that that was that 100-yard pass. That's the highlight reel. Yeah. No, you still have 2 more innings left. You can make another one. Stay in the damn game. But you have to know that the game has a clock, and you better stay in it that whole time. Those who think that they have to go in and out of it, they're the ones that lose. Yeah.
And can we discuss a little bit? You've been in a couple of market cycles yourself.
Yes, I have. Quite a few, actually.
So that's why you're the perfect person to kind of discuss. But in a sense of a real estate investor, we've discussed this throughout our entire series, that investing is a mindset, right? It's something that you commit to. Mm-hmm. It's a way of being, a purpose, because you're creating and building something that lasts way after us, right? And so for the person who hasn't yet made that transition into real estate investing, you know, what kind of advice would you give to that person who's almost ready to make that commitment?
I think I'd have to really ask them what's stopping them, what are they worried about, and what is the worst case scenario that they are envisioning that's keeping them from making that move forward. The thing that's great about real estate investing, you still own an asset. So if you understand what asset you're getting and what's the worst case scenario with that asset, and you're good with that, there's no reason to not move into it. The other thing that's great, I've got a client today, talked to him this morning. I was out washing my car before I went to brunch in it, because it's been sitting in the shop a long time, covered in dust. And he called me up and said, I'm in really bad shape. I need to talk this through.
Yeah.
And as we're talking about all the things that's happened in his business, and a lot of the cash flow that's gone, a lot of the expenses he's had, the things he forgets about is a lot of the equity he has in these properties, because he's been at it for so long. He's now thinking about, after the conversation, I can tap into this equity. There's some of them that are free and clear, really doing him no good, having free and clear property that he's making a cash flow on. But when you pull that capital out and put it to work, you can double, triple his assets and really expand his business. So when we start to see that being in it for a long period of time, being consistent in his business, even though he's going through a dip right now, he had tons of assets and equity he can tap into and pull right out of that dip and actually reposition himself better. By the time we're done with the conversation, he feels much better about his position. He wasn't fretting where he was at so much. He was like, wait a minute, I did build one hell of a foundation that I can pull from. He was still looking in the wrong direction. So you need to have people that can help look at assess your position.
The whole picture.
Exactly, assess everything you have, because you'll have tunnel vision. And when you have that, and you've built and you stayed steady for a long period of time, he was able to admit at the end of the conversation, when I look back on it, I would have done everything I already did before, because they were all good moves.
Yeah.
He goes, I just realized I made good moves where I was crushing my moves for a moment there.
Yeah. Well, and it's really great to have people in your corner that will understand, because out of the experience, and one, you're a real estate investor yourself, right? And that the whole point is to navigate, to be creative with their investments on what they have. And if you're sitting on a ton of equity, it's the same thing as having cash in the bank. It's not working for you, right? It's not doing anything for you. And if you're able to pool and leverage some of that equity into another income producing asset, then you're just doing yourself another favor, and you're building and you're building.
And in actuality, equity is better than cash, because cash in the bank is eroding with inflation. But equity is growing because the asset's growing with inflation. So don't ever think that not having cash is a bad thing. Yeah. All my cash is out. Yes. The suck part of where all my cash is at right now, nothing's paying back, because the market's really interesting out there. All the investments I gotten into, they're right now still trying to correct. They're trying to get to the level they thought they were going to be at, but that's investing.
Right.
But a lot of it was not real estate, and that's why I'm like, I'm changing my thought process. I'm not investing in people's great ideas anymore. I'm changing my philosophy there. You're not investing in a great idea. You're investing in somebody's ability to work the idea. And you need to understand their capability to operate a business and operate an idea. And if their idea is great, it could be great, but if they can't operate it, it doesn't matter how great the idea is.
Right.
Put it into assets. Hard assets, real estate. Precious metals are just going to sit there. They can't leverage them, so you might want to have some of that. But I think real estate's going to be your best bet. People's third-party businesses, you got to question that. And then cash, get that deployed as much as you possibly can. But the one thing I'll always scream: real estate, real estate, real estate, real estate.
Real estate, real estate, real estate. Yes, it's and it's just not only what you can do in how you can create the money with your asset, with your real estate, but the actual accumulation and the tax benefits on the back end too. But it's like, you know when you get it from every angle, and typically you're not sure if it's a good thing, but when you own an investment property, it definitely is. When you're getting it's like even the mindset of like a broken toilet, but it's okay, a broken toilet in an investment property, that stuff is going back, it's going to go back somehow,
when you think
somewhere.
about it, let's just say in the state of Arizona, what's our average value?
Right, yeah.
Average value of a single family here is what, 400,000? Let's just say, right? It's just more of your lower end properties. Where you play, So in some of the rougher spots, let's say it's 400 grand. Well, if it's appreciating at 2% per year, what's 2% of 400,000?
Yeah.
Well, that's 8,000. Well, if you had let's say a toilet and a broken pipe and a couple of things, you had to spend $3,000-$4,000, you still gained $8,000 that year.
Yeah.
So when you consider that, it's kind of hard to argue with. That's only 2%. We're gaining a lot more than 2% in most markets.
Yes.
So there's this idea that I'm sending money and I'm not making it. You're growing anyway.
Yeah.
Eventually you'll be able to cash that out. You'll eventually be able to take that and put that somewhere and expand your holdings. You've got to put your mindset in the right place. You got to know exactly what you're purchasing and why you're purchasing it, and run these numbers. Too often people look at it from how much should I invest and how much cash is coming back. It's not about the cash. It's the amortization, it's the appreciation, it's the taxes. The cash is the cherry on the sundae. Everything else is the sundae itself. The bowl, the ice cream, the whipped cream, the nuts, all that. The cherry is the cash. Don't think of the cash only.
Yes, I love that. And on that note.
Yes, you got to end the note on cherries and nuts.
On that note, I do want to end.
Oh, so we're not ending.
No, we're not ending.
Okay.
Not quite yet. One last thing though, before we do end, and maybe on cherries and nuts, we'll find a way to go bring it back.
See the timing right there?
For those of us who understand that putting a lot of money into an investment, can you please explain a little bit that a short-term loss and a long-term it equals a long-term gain on real estate investing? Sometimes they see that, but that's just how it is. Can you maybe put us in an analogy where we can end on that note?
So let's say that's perfect right there. Hopefully that was the whole line that just went by.
I hope you guys got that. Did you get that?
I don't know. I got it.
I got it. Yeah, that was great. Thank you.
It was loud as hell.
Thank you for that. Just kidding.
Perfect. So when you're talking about when you have a property that has let's say you have a turn on it, you've had a tenant in there for 5 years, great performing property, you're getting great cash flow on it, the same tenants, they never gave you problems, and then they move out, right? They never gave you problems because they just let crap fall apart on you.
I love it.
So then you go in and inspect it after they leave. And it's like, oh, I've got this monster amount of fix. I'm going to have to put $20,000 into this house.
Yeah.
But it's all big things, right? You're talking about mechanicals. You're talking about some plumbing stuff, toilets, things like that. These things are durable goods that will last another 8-10 years, right? So you do it one time, but then you get another, but you have to be cautious what tenants you put in there. Put more in that. So then you've got another run. You have to be discerning who you put in there, the type of tenants you're allowing to put in that place. You have choices. You don't have to let anybody in there.
Yeah.
So the more you get as far as experience in this, the more you'll understand what you're doing as a landlord, and the more you're going to not worry so much about having those capital expenses. The other thing that is a big problem with most investors, they want that cash flow go in their pocket. They want to be retired and live off that cash flow. I'm like, don't do that. Form your LLC to buy it. Form an LLC account where the money comes in and goes out to pay the payments, and it stockpiles and it continues to grow. If you have a capital expense on that or repair of any sort, it comes out of that account, not your pocket. Don't ever allow your pocket to start drawing from that, and then you have to go back to your pocket to take care of it. Keep it separate, have it its own separate business, period. Treat every single property as its own separate business.
Well, we did discuss that, I believe, on week 7 or 8 with Ike Devji, our asset protection attorney, as well.
Okay,
so,
right on.
Yeah. But you know what? This has been a wealth of information. Regardless, which you know Ike, right? You remember?
Yes,
Ike.
I do.
Okay, so I mean, dang. I hope you guys have been listening this whole time and taking notes, and what we have going on in Phoenix is unreplaceable, I think at this point. But thank you, Aaron.
Thank you for the invite. And they're thanking for us.
Thank you, F1. Well, thank you again. Look forward. Cheers, you guys. Pour water, and then we'll see you guys next